Where do you think the next crisis is most likely to come from? What are you concerned about?
So I'll add another piece maybe to the puzzle, which is that we are once again almost back, not quite, but very close back to the tightness of credit spreads that we had before the financial crisis. And when you look at the loans that are being made, particularly for private equity leverage deals, so-called covenant light loans, you look where the high yield market is trading, it's all a little bit scary.
Well, I must say, Jim, I want to go to you and get your thoughts, but I must say, I remember having lunch with Steve about 2007 or so, and he talked to me about credit spreads. I'm not sure I understood it, but he said, David, this is really crazy what's going on. What do you think?
I'm going to follow on Steve's lead here. I think, corporate debt in the United States to GDP is at an all-time high. So the corporate sector generally is highly levered. And it faces significant interest rate risk. If, as the Fed is trying to engineer, we have a significant move up in interest rates, you're going to see that flow through the corporate sector in a way that's going to limit investment capital and profits. And I think the same thing is true for the federal government. The federal government's fiscal posture is really quite precarious. And, today we're spending almost as much on interest as we are on Medicare. If interest rates go back to their post-war norm of 6 to 7% for the 10-year Treasury, interest costs will double. That is going to create a political crisis. As Ray Dalio said, that would create a political crisis here in the United States, putting enormous pressure on Congress either to raise taxes or to cut spending in the face of a potential recession. Yeah. I think the fiscal crisis is just around the corner.
Okay, that's a
sobering.
That's a statement. For the corporate side, though, Steve, the argument against credit spreads being tight is that it's okay because earnings are going up, so they can afford the debt, so it's not a big deal. What's your counter to that?
Well, earnings are going up until they're not anymore. I mean, obviously, if earnings continue to go up, people can manage through this. But we're simply looking at, there's no margin for error. We're simply looking at leverage ratios and tightness and dependency on meeting earnings forecasts that make me nervous.
One of the counters that people say is we've got a lot more reserves in the banks now. We've protected ourselves from a downturn because even if you do have people defaulting, we can deal with it. At the same time, and assets under management have gone way up outside the banks, the BlackRocks of this world, the Berkshire Hathaways of the world. Does that expose us if there is a downturn?
Well, two things. First, I'm not that worried about the banks for the reasons Jim and I both talked about, that the capitalizations are much more secure. But then secondly, so I'm more worried about investor losses and then the cascading effect that could have economically if there start to be defaults and credit spreads blow out again. But then secondly, you allude to a big problem for the future, which is the shadow banking system and the fact that so much lending is now happening in an unregulated fashion.
Totally agree. We've been talking about that all week as well. Jim, to your point, though, on the deficit here in the U.S., that conversation is nothing new, and that I know it's getting worse, but the conversation is nothing new. So when do you feel like the tipping point is going to be for that to create a real crisis?
Well, just look, we're in the 9th year of recovery from the recession created by the financial crisis. I don't think the business cycle's been repealed. And ordinarily during a recession, federal revenues go down and spending goes up because we have a series of so-called automatic stabilizers that kick in: unemployment insurance, food stamps. So a deficit that's running close to $1 trillion today at the end, in boom times, could easily be $1.5 trillion, $1.6 trillion in a recession as a result of revenue declines and increased spending. That would be 7 or 8% of GDP, a deficit equal to 7 to 8% of GDP. That's a third world country's deficit, not the United States of America. So in this sense, Ray Dalio is right. The real risk is that fiscal irresponsibility on the Hill creates a dollar crisis. And a dollar crisis will radiate through the rest of the world.